Okay, so let's take a look at where the US futures are currently trading. Just giving back a little bit of ground after really, really solid gains, as Karen's been telling you, and Juliana as well, in the last week. The US economy added 177,000 jobs in April, higher than the 130 economists have been forecasting. There were revisions going in the opposite direction. There you go. Lower than in March. Meanwhile, the unemployment rate came in at 4.2%, unchanged on the month. Dan Lacalle is chief economist at Recession and joins us now. Dan, the hard data, by and large, is still pretty solid. The soft data, the forward-looking data, people are very, very concerned in terms of where we're going next. Which way is this going to go? Are the people concerned about the future going to be right, or actually are the people saying this economy, it's okay, it's weathering the storm really well and will continue to do so? Are they right?
Hi, Steve. I think that the economy is going to do much better than the negative perception indicates, for numerous reasons. If the tariff impact is going to be so severe as what the most negative analysis estimate, then there will be immediate negotiations. But the indications so far of leading indicators tell us that things are not that bad. Number one, in the GDP print, the investment figure was phenomenal. The investment is what really drives the economy. And consumption was rather positive as well. So the private sector GDP in the first quarter was rising by 1.6%, which means that we can see in the second quarter GDP of around plus 2% once imports are reversed from the negative print of the first quarter. In the employment figure, I think it was very important to see 177,000 jobs created. This is higher than the average of the 12 months prior, but more importantly, it came with a significant reduction in federal government jobs. So I think that all of those elements tell us that things may be bumpy, but they're not going to be as dramatic as they indicate in some of the estimates. For example, inflation.
All right, Dan.
12 months inflation expectations seem too aggressive.
Dan, so, I mean, by my mind, the S&P's rallied about 700 points off its lows in the last month. What do we do now, then? What do our viewers do?
Oh, I think that you continue to invest in U.S. stocks, looking at guidance. Look at the companies that have given forward guidance that is positive for investors. The ones that are more quiet about guidance are the ones in which you have to be a little bit more prudent, particularly because they're very exposed to the cycle. But there are plenty of companies that have given quite reassuring guidance and very good earnings figures. So I would stick to technology. I would stick to defense. I would stick to the companies that are immune, I would say, to the commercial to and fro between China and the United States. I think you want to be in the United States stocks because if there's no other option, to me, I think that if you look at any other part of the world, you have some great opportunities in Europe, you have some great opportunities in the US, but the emerging market stocks look very, very weak in terms of earnings and in terms of profile to me.
So the play the developed markets then. Dan, I want to come back to your comment about the 12-month inflation expectations here and what that means for the Fed, because Trump was weighing in on Jay Powell over the weekend. Good news is he's not going anywhere until May 2026 when his term expires. But the bad news is there's still tension here between the two men, and the Trump comment suggesting that perhaps Jay Powell is not as nimble as he should be on interest rates. Do you think he should be lowering from here?
I think that interest rates should come down. I think that interest rates should come down because all of the leading indicators, as you have very well noted, show that there should be some leeway to cut interest rates and allow some breathing room to the private sector to take some credit. But At the same time, I think that the Fed wait-and-see approach is actually working for them, because the stock market is reacting positively, job figures are positive, all those things are okay, and at the same time, the trueflation figures are showing that inflation is not that high, oil prices are down, gas prices are down, so all those things may help clarify the outlook for a Fed that wants to be stronger in its perception about inflation. So I think that both are right in a certain way. The market is telling you that the Fed should cut 25 basis points and should continue to cut. And at the same time, the Fed wants to be prudent on expectations of inflation that are going to dissipate quite quickly, in my view.
Yeah, Dan, a lot of the central bankers looking for clarity, which is why the ECB was hanging out to the last minute on the tariff news flow before deciding. Can I ask you about what the prospects look like for Europe? Because at this stage, we've had some rate cuts that central banks are trying to shore up the growth story here in Europe, concerned about a growth shock from the tariffs. Is Europe still looking compelling despite all the money that's pivoted behind European assets so far?
Yes, Karen, I think that it's very important to look at Europe in a more benign way, because the manufacturing sector has been improving already prior to the significant rate cuts of the ECB. So there was a little bit of positive news coming from industrials, quite some positive news coming from financials. I think that Europe is sort of navigating a stagnation environment, obviously, in the economy. The economy is not doing well and is not going to do massively better. Obviously, GDP is going to see a little bit of boost by defense spending and infrastructure spending, but that doesn't last for long. But I think that what we need to be very aware of is how resilient companies have been in an environment in which everything was against them. So I would be interested, actually, in looking at the European stock market with a more positive approach, particularly in Germany and in the French companies that have been very severely impacted by the negative political environment.
Dan, you sound a lot more upbeat than the majority of economists that we talked to on the program. And over the weekend, I had a look at what Goldman is forecasting, what Apollo is forecasting. They put the risk of recession at 45%. Goldman, Apollo puts it at 90%. Where do you, what sets your view apart? What are they missing? Is it simply that you think President Trump won't let things get that bad, that he'll step in and he actually is more sensitive to the market than those guys believe?
I think that in general, recession expectations seem to be very biased to political changes. And with all due respect to U.S. presidents, they're powerful, but they're not that powerful. So Biden was not going to lead the economy to a disaster. We can be more or positive or more negative about the enormous increase in government spending, but he was not going to lead the economy to a disaster, neither will Trump. I think that and by the way, I think it is great to read our esteemed colleagues talking about recession risks, which they were not talking about last year, which is phenomenal, because it is precisely that what leads to companies to be a little bit more prudent about taking leverage, a little bit more prudent about non-strategic investments, all of those things. So I think that let me tell you what I see that is different from what they see, if in a nutshell. There is no single indicator of companies and families behaving in the way that they would behave in a recession. There is certainly a lot of indicators of families and business behaving the way that they would in a slowdown. But it's a
slowdown, but not a recession. I certainly take your point, Dan. Nuanced as ever. Dan Lacalle, Chief Economist at Tressis.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.